especially looking at risk. How much risk should I take or not take in retirement? What are kind of some tools or methods that you use to help clients gauge how much risk they should take?
The founder of Vanguard, Jack Bogle, actually came up with this rule of thumb, sometimes referred to as the prudent investor rule or the rule of 100. And this can be a very helpful rule of thumb as a good starting point to help quantify how much money we should have at risk at any given time. So the rule states you take the number 100 and you subtract your age, and it gets you what we would call the prudent amount of assets that you should have at risk at any given point, right? The whole idea being, as you get older, we want to scale back the amount of money that we have in the market and equities, because typically we're closer to needing that money, right? And so that this can be a really good starting rule of thumb. But then from there are what we call individual overlays, right? So these individual overlays help us quantify, situations where we can afford to take more risk, right? So, if we have a 60-year-old client, right, and we take 100 minus 60, saying, hey, maybe 40% of our money should be at risk in the stock market at this point in time. But then we want to look at things like, how much Social Security income do you have? How much pension income do you have? Do you have any rental properties? The more guaranteed income that we have gives us the more permission to take more risk. Now, for most people, I say, hey, just because you can take more risk doesn't mean you want to, right? Everyone has what we would call like a tummy test, what feels good for them. And when we're looking at designing risk, everyone's number is totally different, right? So just because you can afford to have 80% of your money in the stock market, some people are petrified of having their money in the stock market. Now, that is one helpful tool. Another one is what is called the lifestyle return benchmark. Now, when we're looking at building financial plans, one of the most critical places to start is understanding what rate of return does your plan actually need to be successful. In other words, we look at what are your expenses on an annual, on a monthly basis. We take those expenses and we inflate them over a period of 30, 40 years. Typically, we run our plans as like a stress test till people get to, approximately age 100. And we reverse engineer the return that you need for your plan to be successful, right? Because what I find is that most people, they're invested like they need to earn 10 or 12 or 15%. And with that, they have a potential downside of 20 or 30 or even 40%. When we help them determine, hey, your plan only needs 5% on average to be successful, it helps shift their focus for how much risk they think they should take, because most people don't know how much risk to take because they don't know how much risk they need to take. So filling in those gaps for how much risk you need to take, that allows you to then determine, well, how much risk should I take, right? And it's our job to help you understand what the investments are that can produce those types of rates of return on a more consistent basis.
What have you seen as like the lowest lifestyle return benchmark that you've seen a client have? And what would you see as like the highest that you've ever seen?
I think that, for people who have government pensions, a strong Social Security, even potentially some rental income, where they're never going to spend as much money that comes in every month. Their lifestyle expenses are extremely low. They have $10,000+ a month in guaranteed lifetime income and a portfolio with, $1 million. It's like, okay, your plan needs 0.5%, if that. You know what I mean? Just because you have so much income coming in every month that it's you don't have to rely on your portfolio at all, right? Your rate of return that you need to earn is extremely small because you have so much guaranteed lifetime income. On the opposite side of the spectrum, for clients that we meet with that maybe have $500,000 and maybe haven't contributed to Social Security for their lifestyle, right? They opted out, you know what I mean? And maybe they don't have a pension. It's like, depending on how much money you spend every month, you either need to continue working or you need to try to invest to earn 10 or 15 or 20%. You need to put all your money in a Bitcoin ETF. That's not an actual prudent decision, right? And so we need to help people figure out where they are along the way and figure out how much risk you should take But really it's about quantifying, I think, how much risk your plan needs to be successful, and then helping you understand different frameworks for how to look at risk. Because some people don't know how much risk they want to take, right? They're like, well, I don't actually know, and I've just been invested this way because I've never changed things up, but I don't actually know what the right amount of risk to take is. When we're first helping clients quantify the risk that we're taking, and we're saying, you know, here is your risk number, so to speak, and helping them understand how their portfolio is currently constructed and how much downside they potentially have, right? And what level of risk that they're taking. I had a client last week. We walked through their risk number and they were shocked, right? Because from their mind and with the broker that they were working with, they were always told, the broker, they were a moderate investor, right? We look at their risk number and it's like, your model is aggressive, right? And you have the ability to lose potentially 40-50% of your assets if we experience another hard financial time, economically speaking. And for those clients, it was eye-opening. They were almost sick to their stomach, right? It was like they can't believe, because what they thought was happening within their plan was not actually happening, right? And so being able to really paint that picture and help people understand that it's okay, because there are changes that we can make. You're not too late up until this point, but we need to be proactive in making these changes to make sure the expectation, the amount of risk that you think you're taking, is actually in alignment for what your portfolio supports.